Dean, it's great to have you back. It seems like just like yesterday, you and I were having coffee in Austin. It was hot, and now it's September. We're past Labor Day. Kids are back in school, and we've got a weakening U.S. dollar. What impact is this weakening U.S. dollar having on the oil market?
Well, historically, oil and the dollar have almost moved, inversely 1-to-1. And that's because crude is priced globally in US dollars. A weaker dollar makes oil cheaper for foreign buyers, and historically that's supported demand. So right now the effect is reinforcing strong fundamentals. Economic growth has continued. We've got record global demand, relatively low inventories. That relationship, it's not perfect, but it's one of the clearest, most consistent drivers that we've got in oil market.
And then there's the other thing that's going on. You can't turn on the news without hearing interest rates, interest rates, interest rates. There's this side of the interest rate debate, that side of the interest rate debate. How closely do we need to be watching interest rates as it relates to the oil market?
Pretty closely. Interest rates matter for a couple of reasons. First, they shape the cost of capital for energy products, for broader capital investment. Second, they really influence the strength of the US dollar. We've gone through a period where other countries around the world have been cutting rates and the US has been holding pat. And that could change. If the Fed keeps rates higher for longer, that could weigh on equities and consumer spending as well. So if the rate cycle has truly peaked and is starting to turn here, that could be supportive of growth in energy demand into next year.
Where's the growth going to come? Because we had the ADP revision that came out where, unfortunately, individuals are losing their job at larger numbers than was first reported. If they're losing their jobs, where's the demand going to come from?
Well, it's more supportive of the demand growth that's continuing. We have demographic shifts that are coming, but despite that, we've seen consumption and household debt continue to expand. So that is 70% of the U.S. economy on an expenditure basis is consumption, and holding up consumption. Part of it's a wealth effect also. The fact that U.S. equities have continued to reach record highs makes more affluent households, the top 20% that are driving consumer spending, feel affluent and continue their spending patterns without really changing as a result of shifts that we're seeing in the broader labor market.
You touched on the boogeyman, household debt. It's currently $18.4 trillion, a record. That's a large number. It's a trillion with a T, not B with a billion. How concerned do we have to be about that?
It's definitely a key concern. It's something that we're monitoring. It's the reason we featured it in our quarterly outlook, really over the last year as one of the prime things to watch. And it's not just the level, the record high level of debt. It's the delinquencies, the serious ones of 3 months or more on credit cards in particular, also student loans. We went from, with the reassertment of or payments on student loans, the prior quarter, entering this year, we saw almost instantly 9% of them become seriously delinquent. This quarter, for the second quarter in the New York Fed's credit monitoring panel latest data, almost 13%. So that's a lot of young people that are seeing credit ratings potentially get damaged as a result of not being able to pay these loans. And that can have a compound effect for consumer spending that we need to watch. It's a critical point.
It could have a compound effect, and it's going to stay with them for potentially decades if that part of the consumer, the lower end consumer, the younger consumer begins to crack and consumer spending starts to slow down across the board. What impact does that have on the oil and natural gas market?
Well, consumer spending is tightly linked to oil demand. We see it could hit gasoline, it could hit diesel fuel, jet fuel use in terms of just discretionary income that affects travel. So, everything from commuting to freight to travel. That said, global growth has continued to remain strong because of emerging markets driving that growth. But there could be softer spots that we see in developed economies. U.S. demand could eventually weigh on prices given the supply-demand balance if it loosens. So far, that's not the case this year, but that's what we're watching for.
Are you watching for any, I'll use the polite term, hiccups in the global emerging markets of anything that could potentially bubble up to be a concern to you?
Always look carefully at China and what's happening there in emerging markets in general. As a result of shifts in trade policy, we're also looking at shifts in supply chains and how that's affecting the energy value chain.
Do you see any impact potentially of what the U.S. is trying to do as it relates to the movement of metals and how that could potentially have an impact at all from the traditional supply chains moving to more of the domestic supply chain?
Well, metals could be a leading indicator of what's happening with supply chains generally. It's not something that I'm watching very carefully, but I'm looking at where trade patterns in general are going and where energy trade patterns are shifting. And that does tend to affect the price and the business environment based on, we're looking at everything from what OPEC's behavior is, where China and India are buying. That shifts patterns, both for oil and for natural gas.
I want to go into some of the numbers here in natural gas because every quarter you publish this fantastic outlook, and I want to highlight some of the numbers here, and I want to start with natural gas and put that into perspective here with numbers. You reported that global natural gas demand reached a record 148.7 trillion cubic feet in 2024, and is expected to rise another 1.8% in 2025, with roughly 75% of the growth coming from, you said it, emerging markets, including Asia. North America is poised to supply 85% of the incremental LNG capacity in 2025, led by, drum roll please, Texas and Gulf Coast projects. Wow.
So the question in there is, what's driving the growth, right? And the combination really of a pull on the demand side and a push on the supply side. When we talk about demand, emerging markets, especially Asia, that's your main growth driver, and it's power generation and it's industrial use mainly that you see there. And they also, from an environmental perspective, want something cleaner than coal, so that continues to support demand. With China, India, Southeast Asia in general still urbanizing, industrializing, and natural gas is giving them a way to improve the air quality, the reliability, lower carbon intensity compared with using coal. But then on the supply side, especially led by Texas, we've got the geology, the infrastructure, and now the policy environment that's really supporting continued delivery. And we've thought about the shale revolution historically as this burst of abundant, cost-effective energy, both on the oil and the natural gas side. Natural gas liquids that get extracted from the natural gas stream are quietly a major liquid supply source. That's been hitting records again this year of over 7 million barrels per day of NGLs coming out of the U.S., 4.1 recently, a record high out of Texas. So that's a milestone that quietly is really worth watching, and it's important to petrochemical markets. Texas alone now is accounting for about 30% of U.S. marketed natural gas. That's as of July, and 42 to 43% of U.S. oil supply. So it really is the powerhouse led by the Permian Basin and Texas. The Permian Basin also on the New Mexico side just continues to hit on all cylinders.
30% natural gas, 42% oil. Those are impressive, but I got to put the growth hat on here. Will we continue? Are you projecting that to continue to grow?
Well, it sure looks like it, because that's where the infrastructure has been most enabling of growth. The geology is favorable, it's cost effective, and it's where it's possible. So you're seeing the most M&A activity, mergers and acquisitions within the industry, the best of technology getting with the experimentation first in the Permian Basin. It really is the premier growth source. And if we're looking across the U.S. in general, the amount of growth, 80% of U.S. oil growth this last year, or year to date compared to the same first 7-8 months of the year last year, 80% of that growth is out of the Permian Basin.
With all that growth, I'm assuming that's having a positive economic impact on Texas's economy.
For sure. And we'll be updating by year end we call it our Energy and Economics Impact Report, an annual assessment the Texas Oil and Gas Association puts out. Last year, it was supporting 1.3 to 1.4 million jobs. It was paying $27.3 billion worth of taxes from one industry in one state. That exceeds the entire state tax receipts of 34 different states, to put that in context. So it's massive for Texas economy. It's a pulse through all of the manufacturing value chain and trade. You add on top of that the fact that we are now a premier LNG export platform. And even though LNG out of Louisiana is still slightly greater than that in Texas in terms of just the existing terminals, with new construction that'll change. But 60% of the gas that's going out of Louisiana is coming from Texas and New Mexico. So it really is important to see that flowing, that entire value chain continuing to burgeon.
It's an economic growth engine. I mean, that's the way that I look at it. And last time you were on last quarter, we spoke about the growth of natural gas as it relates to data centers. And I went and did some work. I spoke to elected members of Congress. I spoke to large data center operators. and there was a consistency. We love natural gas. We need natural gas because we need to power these data centers because of how much energy it takes to power the AI that we use every day. And speaking with these large hyperscalers, these individuals operating these data centers, it seems to me they can't get enough energy. They'll take everything they can get. Do we continue to see over the next quarter a lot of natural gas going to power these AI data centers?
Absolutely. But let's be clear, today's natural gas growth, as we look out the window, it's mainly about industrial demand and international demand for it. So as Asia takes more natural gas, as Europe shifts away from Russian gas, that pull for LNG exports has overwhelmingly been the demand source that's grown the most in the United States. But then we look forward and the build out of AI and the need to co-locate a power source to go with the build out of it. It's cloud computing, it's high performance computing, it's generative AI, it's all of those things that need 24/7 electricity demand. And the most cost effective, easy to build way of getting that is to co-locate natural gas generation to go with it. So natural gas continues to be a bridge fuel as we're ramping up and really just on the front end of the data center growth.
Is that a common practice or is that a new emerging practice as relates to nat gas?
For large industrial facilities, it's definitely something that's existed for a very long time. I think given their choice, you really want utility scale generation where you can get it. So if a grid from Pennsylvania to Ohio to Northern Virginia to Texas, if they've got extra power that's available and it's cost effective and consistent, that's attracting hyperscalers. There are other considerations, fiber connectivity, workforce, what have you, and the business environment in general. Texas has been very attractive across all of those elements. And areas where it has spare power from a utility, they're getting connections, and in a real estate play that's really growing up where you're seeing people develop sites, attract the hyperscalers, and kind of meeting of the minds bring that together. But for many of them that want to drive it themselves, they really are looking at a backlog now of orders for natural gas generators, the actual turbines, and whether you're putting in combined cycle turbines, aeroderivative units, or reciprocating turbines, depending upon what you want, whether it's on the scale 24/7 or just peaking to offset what you otherwise get in intermittency from other sources. That ends up being a cost-effective way of trying to build it out relatively quickly without waiting for a utility to have the permission and the ability to build out the grid further.
We've documented on the road to autonomy many times the utility build out could take years. We don't have to go into specifics today, but it's very clear that the natural gas market's growing. AI data centers is one part of it. Emerging markets is a large part of it, but it's not just natural gas that's growing. The oil market is continuing to grow and showing some pretty incredible resiliency. And I want to highlight some numbers here, which you highlighted in your report. The U.S. Energy Information, the August 2025 update, they raised their global oil demand forecast again. That's right. They raised it again, now projecting 3 consecutive records: 103.7 million barrels per day in 2025, 104.9 million barrels per day in 2026. What's driving this demand? Because every time I come on, let's go way back here. Ever since the first time you came on, oil's only continued to grow. And when you came on, it's not going to grow. But lo and behold, every quarter you're on, the same consistent story. It's growing. What is driving this growth?
So if there's one benefit of the outlook process that I've used for years, and I've had these conversations with you each quarter, I think I take pride in the fact that we've been really spot on in terms of demand trends. And if you understand the economy built up by 200 economies around the world and really look at it by sector, it's hard to get the demand side too wrong, because that relationship, even through the pandemic, that relationship between economic growth and oil has been so strong. So look, right now we've got a mix of economic momentum and structural drivers that are leading to these consecutive record highs. And it's often cast by analysts as an emerging market growth story, but developed economy softness. And let's be clear, historically in long run growth averages, like for the US or other developed economies, if it's growing a little more than 0.5% per year in developed economies, usually that's pretty strong. And this year, through the first 8 months of the year, year on year, and EIA data, we're up almost 1% year on year, despite the fact that gasoline consumption's slightly down. So again, this is really interesting, at least to me, because diesel's up 4% year on year. Jet fuel's up 5% year on year so far this year, and petrochemical demand or feedstocks are up 3.6% year on year. So this mix, it shows oil demand growth coming from industry, travel. Now that's every bit or more important than what's happening at the gas pump.
The diesel demand is interesting because the freight market's in a freight recession. Is that coming from diesel demand? Is that United States? Let's break that down a little.
Well, you have both an industrial side to it, a manufacturing side to it, as well as we just touched on data centers, but sometimes the data center is going to put in a diesel generator, not just a natural gas generator. So that's also helping boost it where you need short-term power solutions. You can get that from diesel.
It seems that a lot of roads, not all roads, it seems a lot of roads go back to these data centers at the end of the day.
It's definitely got multiple touch points, and it's a source of generational investment. I mean, I hope it's not the dot-com bubble that we had at the turn of the century, but we are definitely seeing a lot of productivity that's really just on the front end of it. The potential is tremendous. But from a state perspective like Texas, we're looking at it as not quite zero sum, but we're definitely competing with other states for data centers and trying to attract a generational change in the infrastructure that goes with the economy.
There's something that your state has that a lot of states don't have. You have one of the best regulatory environments in the United States to attract businesses. And most importantly, Governor Abbott would love to hear this, keep businesses in Texas. You have a great regulatory environment for that because you have the energy, you have the land, you have the skilled workforce, you have the right infrastructure, you have the right tax environment, you have all these really great ingredients as we've seen with the growth of Texas, which has been well publicly documented there. So as you and I both know, every quarter you come on, the oil markets are growing, but you and I have these great conversations around economics and what potentially could happen. And when I look at the market, I see the potential, I'm not saying definitely, I see potential weakening in the economy. If that happens, does oil still continue to grow? And if so, is that offset by the global demand?
Well, the global picture has remained solid to this point, and we're looking at leading indicators to see if we see turning points in that. In the U.S., there's definitely a soft patch in the data that we're seeing, and we've highlighted some of these in our weekly, monthly, and quarterly reports. The ADS index from the Philadelphia Fed being a prime one that kind of shows stall speed as of this quarter. In terms of oil demand, though, this is given the global backdrop, this is more of a leveling off in the growth as opposed to a structural drop. And keep in mind, during the depths of the pandemic, in the worst quarter where you were shutting down travel in parts of the economy, the world still needed over 80% of its normal demand just to make things run. So that intrinsic relationship of what keeps it going is there. And from a growth prospect, again, just highlighting the U.S. statistics so far this year, the fact that petroleum demand's up almost 1% year on year in the U.S., this is underpinning why we're continuing as the economy, even if it goes more slowly, it's still looking at growth for the oil market.
Is it fair to say that petroleum is a key component of the global economy?
Absolutely foundational. So the transformation of energy markets in general, the fact that transportation systems, over 90% of the energy still comes from liquid supplies. Oil really is what makes it go, and it's unique energy density that helps enable that.
And let's go to the supply side here of oil, because you have some really interesting data. The EIA is projecting that global production growth is projected to exceed demand in 2025 and 2026. Here's the interesting part in this report. Led by non-OPEC producers such as the U.S., drill baby drill, with additional contributions expected from OPEC and Russia. I saw Russia and I said, wow, we don't have a ceasefire yet. We don't have an agreement. How is this oil going to come onto the market?
This is one of the key points for a listener to really take into account. We've got mediocre economic growth, right? Not exactly booming. We have record oil demand and growing, but yet we still have relatively low or moderate prices for oil and a market that expects the world market to be awash in oil. So part of this is the fact that you've got pent-up supply, long lead conventional projects coming out of Guyana, Brazil, Norway, Canada, on top of continued U.S. growth that's been healthy this year. And that's fueled by productivity gains, by the way, in the U.S. that we can talk about in a sec. But then on the OPEC side, that keeps pressure on them to keep supply sufficient to, ride this balance between a healthy price that's compensatory for what they need for government spending and continuing to guard their strategic concerns over market share. Russia, having been hampered somewhat by sanctions in recent years, has kind of helped the rest of OPEC kind of maintain that balance. But they had announced a few months ago, last quarter, we talked about their announcement of wanting to put 2.2 million barrels per day of new supply back on market over a period of 18 months. And they've put a sliver of that, really 800,000 barrels per day back on market. And the demand growth has enabled that, right? But they still have a lot of spare production capacity. They could put more on. So read the tea leaves now on what happens geopolitically with Russia, Ukraine. If you see a peaceful resolution, that opens the spigot for Russia to put more back on market, to continue to position for growth, to reclaim some of the markets where it's ceded share over the last several years. If we see that protracted, and this is actually part of what in recent weeks has helped support oil, is that we've shifted from a market perception that there would be a resolution to saying it looks more protracted, like it might could continue. And if that continues indefinitely, then Saudi Arabia plays a more prominent role in maybe continuing to increase supply. Others of the OPEC syndicate have kind of found it difficult to meet their quotas. So it really is about what happens with Saudi Arabia and Russia that's pivotally important to markets here.
But there's a country you didn't mention yet that's out there. President Putin's there, publicly been documented this week, China. Where and when does China come into the picture? I asked that purely from their buying power perspective. Then I also asked that from a geography perspective, where they're located as it relates to Russia.
Well, there's an oil side and a gas side to this. In terms of oil growth, China and developing Asia is still your prime demand source, and they've been quietly willing to take a lot of oil directly from Russia, India as well, Turkey, your third source. That's where the majority of Russian oil gets placed. As long as their demand growth and their economy are continuing, that holds together, and it's a global commodity, globally traded, that's continuing to grow. From a natural gas side, this week it was really interesting that the meetings in China resulted in a proposal for a Power of Siberia 2 pipeline that could have capacity in the next decade of up to 5 billion cubic feet per day. To put that in that context, that volume from that secondary pipeline expansion is equivalent to about half of what LNG is imported into China today. So if you're looking for tectonic shifts in global natural gas markets, it won't happen overnight. You'll see it a mile coming, but that could really diversify and create more competition for supply sources into China.
If you look at the numbers that you so elegantly put out there with the Siberia 2 pipeline, to me, that has a lot of geopolitical ramifications involved with that. Does this bubble to the point where we start seeing this in diplomatic channels? We start seeing this start to come up in more of the, I'll use the mainstream news. Look what China is trying to do here from a pure energy, if you want a standpoint.
Well, I think it's a continuation of an ongoing plot for China, and the theme continuing to be diversify sources of supply. It's a way of them managing their economic and supply security to go with it. So it's not new, but the tensions that we've seen elevated geopolitically have kind of forced the economies in Asia, Russia, that axis to kind of work together more than they otherwise might have. It is important that in global gas markets in particular with Asia Pacific being your historical source of supply growth, both the price linkage contractually, historically back to oil, that was one element, but security of supply and diversity of supply are the other elements that really kind of make that work. And this is one of the questions, is how will this market that is so important for the globalization of natural gas continue to grow if security of supply can't continue to be trusted? It's really important, therefore, that the rule of law, the continued expansion and growth of these export facilities and the pipelines to support them through the value chain, plus the continuation of the supply that we're seeing out of the Permian Basin, Texas, the Gulf Coast in general, that's continued to show strength. And contractually, we're seeing people continue to line up for it. So they're good signs so far, but these are the risk factors that we're looking at going forward.
We're not in sweater weather yet, but we're getting there. At some point in Q3, we will be in sweater weather. When do you and I start to have the dialogue around either it's going to be a mild winter in Europe, it's going to be a cold winter? When does that conversation start to enter the picture?
That's a great question because it's Northern Asia, it's Europe, and it's North America, really as one conversation about what winter tends to look like. And natural gas markets have recently shifted back and forth in terms of sentiment on this. It's gone from earlier this year projecting prices to rise steadily in the futures, where futures went from $4 up to $5 per million BTU by next winter. I mean, big increases and historically high that when you're above $4 per million BTU all day, you substitute coal for natural gas just on a per BTU basis based on relative prices. That's where the crossover starts. So you would use a lot less natural gas and domestic power if those prices turned out. But in the last month or two, we've seen the inventories get historically high. We're still sitting in the top 20% of the 5-year range in terms of domestic working gas and storage. So the fact that we've rebuilt those inventories so strongly is another sign that says, well, maybe we can handle even a modestly cold winter as we go into it. So to the day, we're sitting around $3 per million BTU, slightly above it. We've gone plus or minus, at the high twos, the low threes. That's taken some of the air out of that trade. So if you follow our weekly chart book, by the way, we look at mean reversion. We look week to week and say, is it above? Is it below? Based on what the historical target would say. And it really is historically based methodology. It's not forecasting. As a trade association, we try to stay away from that. But it's interesting that has been, both for oil and natural gas markets, a really useful and consistent tool. And we've seen it now where the prices for natural gas have come back into line with this historical range. And now, depending upon what happens here in the shoulder season for winter, we're going to read over the next few weeks whether people are expecting something historically cold and more of a global pull from the US, or if there's a warmer winter, you could see prices depressed. It could go either way.
When you say storage, is that natural gas stored in Europe? Is that natural gas stored in America for export? Where is that stored?
Everybody has caverns in which they store natural gas. This isn't usually above ground tank storage. And these underground caverns that store, we use the term working gas as opposed to the total volume of gas, because working is what you can actually take out without completely depleting the system. And working gas is basically the flex of what you can work with. We're seeing that you've got it regionally across the U.S., a lot in the Gulf Coast concentrated. You've got it in Europe. You have it in China too. And as that plays out, that gas storage, you produce it year round, but you consume a lot during heating season. That industrial demand is kind of a base load demand for gas. But really that seasonal heating need from residential to commercial is really what creates the flex seasonally in terms of natural gas demand.
In Europe, if we do go into and we hit the sweater weather, the jacket weather earlier than is expected, they start to dip into the gas supplies. Who steps in to supply the gas Europe's needed, and what kind of political malice are we going to enter if that is indeed the case?
Well, I mean, another great question, because historically Europe would balance supplies from Russia, a large portion of domestic supply, LNG coming in, and then pipes from Northern Africa. And with the continued globalization, LNG markets and trade, with the sanctions on Russia and Europe explicitly shifting off of it, and we've seen up to 3/4 of Texas LNG exports going to Europe at times this year. And it's down a little bit, and Asia's stepping back up based on just relative demand. But this is always a very regional and seasonal market. It's very price sensitive, again, with these crossovers via coal in particular, but in general versus other sources. And that is It's globalized in the sense that now our U.S. storage for natural gas serves an increasingly global role, which means it can be drawn down further. But at the same time, we're also on the supply side looking at saying we can produce it faster than we used to as well. So those dynamics, they compete against one another, and net net, here we are still with $3 per million BTU gas, historically low, with globalization and with record high exports in recent months.
A practical standpoint from the U.S., is a lot of that energy, the natural gas, the oil, is that coming from the Permian Basin? Is that our growth engine here for export?
It's a growth engine in general for natural gas and for oil. And in the Permian Basin, you get a lot of natural gas associated with that. So if you're looking at a share of the growth of natural gas also coming from the Permian Basin in Texas, it would be high. But to support exports specifically, you also see the Haynesville dry natural gas area of East Texas and Louisiana supporting exports, both because of its convenient location and infrastructure, right adjacent basically to LNG exports, but the fact that it's just the economic crossover. So when you build these $5 billion at a time LNG facilities or trains, each one is going to commit to either 700 million cubic feet per day up to 1 billion cubic feet per day of incremental supply needs. You don't just build that based on expecting to go to a liquid trading hub and draw that on a so-called spot basis. That wouldn't justify multi-billion dollar investments. What you do is you have long-term contracting in place. In other countries, you would explicitly tie certain resources to those export facilities. It's not so formal through the value chain here domestically, but effectively you do have long-term supply contracts in place that then support the development. The supply is incrementally going to come from either the Permian, the Eagle Ford, or the Haynesville, or Appalachia, but it's going to come from somewhere with certainty to make sure that that facility can operate.
Are you seeing any signs of continued investments in these facilities from an oil and natural gas perspective? Are these companies continuing to invest?
100%. Now, some of the uncertainty, we had two sources of uncertainty in recent years. And as recently as last year, uncertainty over the ability to expand and permit and build. The permit issue was really considerable. That, with the new administration, that has largely gotten much better. So you've seen green lighting of a lot of facilities moving forward, taking affirmative financial investment decisions. So across Texas, we have really two operational facilities, a third coming online that's in commissioning. And then we've got, if we're exporting, 4 to 5 billion cubic feet per day of LNG today from existing facilities, and if we count some of the Louisiana facilities, it can be 8 or more. We're looking at adding another 8, basically doubling that within the next few years based on the facilities that have taken affirmative decisions and are under construction. So that's not speculative, that's coming, and that's a lot of natural gas production growth to support it. It's pipeline growth to support it. It really is a huge economic boost and energy supply chain boost that's very likely to continue into the next decade as we need more and more natural gas.
The demand's there, but let's get back to the economics here, because on August 2nd, 2025, the ADS Business Conditions Index from the Philadelphia Fed was sharply revised downward. Could that potentially slow down some of its investments, or is the demand so high for this they continue to invest?
For the reasons we talked about with data centers and a structural shift, I think the demand is baked in at a reasonably strong level. The ADS index, it's kind of like an early warning system. Effectively, it's a real-time read on what GDP growth is likely to be for that quarter, and it's more timely than the GDP data themselves. So it's basically saying right now that the third quarter is kind of at stall speed. That's not a recession call, but it's definitely a sign that the momentum that we're seeing is fragile, and that matters directly for energy demand.
And the other big issue that at least this audience is very interested in, October 1st, the $7,500 EV tax credit goes away. You and I spoke, and I think it was a year ago, 2 years ago, that the amount of oil used for gas for cars is not as much as I originally thought until we became friends. Will that have any impact?
Over time, perhaps, but it's not an instant impact. And keep in mind that EV sales as a segment of overall vehicle sales are still a sliver. So look, if that slows, I mean, directionally, you're saying more oil based fuels or petroleum based fuels as opposed to electrification and transport. But net, it won't move the needle in terms of oil or natural gas at that point.
With all the growth that's coming from oil and natural gas, how much of that can be contributed to technologies that are allowing companies to refract, to optimize drilling? How much of that can be contributed to technology?
Well, the comparison, if we go back to 2018 and 19, Texas and the US in general were producing about a fifth more output with 40% fewer rigs. Think about that. 20% more coming from with 40% less drilling activity. That it's phenomenal, and it's continued. And this is not AI. This is just more data analytics and analytical decision making, real time learning. As AI gets into it, it may continue that trend. And we touched on this last quarter, but the ability to go back and refract, to hydraulically refracture existing or mature wells increases the recovery factors with existing infrastructure even more. So there are a lot of sources of potential growth here that say the shale revolution in the US can continue for decades.
Here's a technology question. I know I'm going to come out of left field, and I'd love to get your opinion. At some point, I'm not asking for timeline, but at some point in the future, do we get humanoid robots in the oil field at some point?
I don't know. If you watch Landman, it doesn't seem like anytime soon.
Landman was great. And staying on the economic output here, what impact does Texas oil and natural gas industry have on the U.S. economy?
It really is pivotal. I mean, it's core. If you think about, it's not just about the direct numbers. And when we talk about, Texas oil and gas, we're supporting about 1.3 million jobs, billions in value added, but it really is the effect of keeping fuels abundant and cost effective through the entire value chain. And the fact that the Permian Basin and Texas in particular is continuing to supply the vast majority of the growth is really important. And it's easy to look past that because you just see system-wide numbers, nationwide numbers that look great. But when you're talking, if U.S. crude oil production is sitting at 13.4 million barrels per day, and U.S. natural gas liquids production a little over 7 million barrels per day. Out of Texas, we're talking 5.8 million barrels per day, record highs of crude oil, plus another 4.1 million barrels per day of NGLs. So it's, again, record amounts and growing is what we've continued to see from Texas. It is productivity driven. It really does, by keeping everything affordable, the entire value chain, petrochemicals, manufacturing, both the direct and all the indirect and induced activity that comes out of it is consequential nationwide.
I'll say it my way. Texas oil and natural gas industry is good for the U.S. economy, and as economic benefits, it's a job creator. Dean, every quarter I learned a ton. This quarter was fun. We went all into geopolitics and what if. So we looked to Europe. We're getting into weather. Next quarter, when you're back on, those folks up north, they're going to be in jacket weather. We're in Florida. We're still in shorts weather. What do we need to look for in the oil and gas markets over the next quarter?
I think really three things to watch. First, global demand. We've talked about the record consumption growing both for oil and gas. Need to watch that. We need to see if any of the economic softness in the U.S. or Europe starts to undercut some of that momentum, and whether Asia Pacific in particular kind of stays on par. Right now, looks good. Second, supply discipline. We've talked about Russia and OPEC and the importance there. So EI is projecting supply to grow faster than this record demand this and again next year. So a lot hinges on what OPEC Plus's policy actually is. And if they loosen, that could be pressure on prices. It's really important to watch. And third are inventories and geopolitics. So U.S. commercial stocks. We didn't really touch on the inventory levels of crude oil in the U.S., but both the commercial inventories and the Strategic Petroleum Reserve are still low by historical standards. So that leaves markets relatively more sensitive to potential disruptions, whether we're talking about sanctions enforcement on Russia, tensions in the Middle East, storm season coming through the Gulf Coast. We need to watch those three things.
You highlighted something we got to touch on before we go here, the SPR. Read the Financial Times every day. You don't hear a lot about it. You're not hearing it. About 2 years ago, year and a half ago, you couldn't turn on the Financial News Network without going an hour about hearing about the SPR. Is it slowly getting refilled? Is it sitting at low levels? Where are we with the SPR?
It's slowly getting refilled, but it's sitting just north of 400 million barrels. So, look, it was sold off. About half of it was sold off in 2022. It's not going to cover an extended period, an extended disruption. That said, we just went through some historically disruptive Middle East politics. The attack on Iran, everything that happened with Israel, and despite these Middle East geopolitics being really elevated, we didn't see a big escalation. There was some, but that price premium seemed to come back out of the markets as a result of this getting resolved, and we made it through. So the fact that the U.S. supply and Texas productivity, everything that we've been talking about in these other aspects has been so strong, the timeliness has improved, that has increased market confidence that we can step up and deliver in short order if there is a need.
I got to study up on the SPR because next quarter we're diving into the SPR, and that's how we're going to start it unless there's a major movement in the oil markets, and then we're starting there. The future's bright, the future autonomous, the future is oil and natural gas. Dean, I love having you on every quarter. And to our listeners with giving their really great feedback, and to the trucking community, thanks for your great feedback. Dean and I talked about it before we recorded today. We will start including more diesel commentary. So thanks for the great feedback. And Dean, I love having you on. Thank you so much as always.
Love it. Thanks, Grayson.